I'm Emily Chang in San Francisco, and this is Bloomberg Technology. Coming up in the next hour, will there be another presidential debate? President Trump refuses to go virtual and wants the dates pushed back. Vice President Joe Biden saying not so fast. And the real winner so far seems to be the fly. We will discuss. Plus, the role of politics in business. 60 Coinbase employees are walking off the job after the CEO barred political activism at work. We will have a live report. And the rise of SPACs. Longtime venture capitalist Keith Rabois, who just took his company Open Door public via SPAC, joins us for a look at public and private markets amidst a pandemic and an election. But first, U.S. stocks climbing to 5-week highs today on speculation a stimulus plan will get done. That and some deal-making lifted the markets today. For more, I want to bring in Bloomberg's Abigail Doolittle in New York. Abigail, walk us through the market action today.
Well, something a bit new today, Emily, and that is the fact that markets were relatively calm. Although the word relatively is important, but we did have a bullish ending for stocks. As you were mentioning, the S&P 500 finishing at its best level since early September. And for the most part, stocks were higher all day. Now, there was one little wobble late in the morning here on the East Coast when Speaker of the House Nancy Pelosi said she won't accept a skinny deal on airline stimulus or a bailout for the airlines, $25 billion, unless it's included in a bigger deal. So we saw the S&P 500 give back about 0.3%, where we saw a little more action on that. Not surprisingly, the Dow Transports on the open, another record high, up about 0.8%. Then that headline came out briefly lower, but just down 0.3%. So relative to the huge moves we've been seeing over the last week, that's nothing. Then you do see the Dow Transports climbing at the end of the day, the major airlines climbing. So this tells you that investors really think that we're very likely to have stimulus, some sort of stimulus at some point is going to get done. Since July 31st, the S&P 500 up about 6%. That was when the big stimulus deal was supposed to be put in place. So again, it tells you traders think it's likely. As for some of the individual movers, and it is interesting, Emily, I should note, bonds did climb on the day too, so that points to a little bit of uncertainty even as stocks were climbing. But in terms of individual movers, Square, super interesting, up 1.8% as they did make a $50 million investment in Bitcoin. That is about 1% of their total assets. And CEO Jack Dorsey, as you know, is a fan of cryptocurrencies, thinking that it could be one of the currencies used more widely in the future. Regeneron, the biotech giant, applying for emergency authorization for its COVID-19 cocktail of antibody drugs that President Trump used, has used, but is saying that he's going to try to make this available for free to folks at hospitals and that it's a cure. That, of course, is not backed up by science, but a bit of an advertisement there. So those shares higher. And then bringing it back to the macro, what we're seeing supporting the idea that maybe things are calming down just a little bit. The VIX, that fear index for the S&P 500, Emily, well off of its September high. So perhaps we're going to go into this election season and things will calm down just a little bit. At least that's the story on the day.
Well, who knows? You know, Abigail, I'm not sure I would bet on it, but you will be watching. Thank you so much. Bloomberg's Abigail Doolittle there. All right, now to some of the debate talk today, a lot of it, but not necessarily about last night's vice presidential debate. Our Democratic nominee, Joe Biden, his campaign rejecting a proposal from President Trump's camp to push back the second and third presidential debates by a week after the president said he wouldn't participate in a virtual event. A Biden campaign official saying, quote, Trump's erratic behavior does not allow him to rewrite the calendar and pick new dates of his choosing. For more, we are joined by Bloomberg's Gregory Corti, our senior national politics correspondent. So, Gregory, will Trump and Biden have another debate at all?
Well, today it's certainly looking like they're pretty far apart on this. Vice President Joe Biden says, look, the schedule's been locked in since the summer, and the format has been locked in really since the early 90s. We have 3 presidential debates. The Commission on Presidential Debates selects the time and the place. President Trump isn't comfortable with having a virtual debate. But, you know, President Trump has a lot more to lose by not debating than Joe Biden does at this point. He's down in the polls. He needs to make up ground. And so just like we've been seeing this week with the stimulus talks, President Trump pulling out of them and now, you know, trying to look for a deal, I would not be surprised to see President Trump coming back in and trying to find some face-saving way to get back into a debate with Joe Biden, because he just needs to make up the ground.
Now, speaking about last night's vice presidential debate, at the start of the debate, looking at Twitter, it seemed like some of the more snarky commentators were a little bored. And then you see the fly landing on Mike Pence's head and fireworks go off on social media. We saw hundreds of accounts created, dedicated just to the fly in a matter of minutes, with tens of thousands of followers, endless bad jokes, memes saying, with RBG saying that she sent the fly, the Biden team starting to sell fly swatters. Will the fly actually matter in the long run?
You know, I'm sort of a bad person to ask about that, because I had my head down listening to the debate for actual substantive policy differences between the two candidates. I almost missed the fly completely. It was actually a substantive debate. But look, those are the kinds of things that really sort of penetrate the national consciousness. Most people aren't watching debates to really do a deep dive on tax policy or that kind of a thing. And look, I think the Biden camp has handled it pretty well. In addition to selling the fly swatters, they also, within minutes of the debate, had registered the domain name Fly Will Vote, which is sort of a riff off of its iwillvote.com website, trying to register and lock in, get out its supporters to vote. And so, yeah, it's certainly a moment. And people were looking for a moment, because this debate did not really provide the fireworks that we saw in that super contentious presidential debate last week.
Aside from the fly, that is. So speaking about what's to come, I mean, if there is no more debates, if there are no more debates, who loses?
Oh, certainly President Trump needs the debates far more than Joe Biden, and it's been that way really since the summer. We started with this time-honored tradition of debating the debates all the way back in June, July. President Trump sort of raising the idea that maybe he would not participate, that he wanted to dictate the terms. But also he needs the debate as a game-changing event. Look, we have more than 4 million people have already voted in this election with mail-in voting. Many of those ballots, by a 2-to-1 or 3-to-1 margin, are being cast by Democrats. President Trump needs to make up ground, and quickly. And we saw that last week. President Trump being on the attack, very aggressive, both with his physical presence and trying to interrupt Joe Biden, knock him off his game. And that's why I think President Trump also needs an in-person debate, because in a virtual debate, he won't necessarily have the open microphone. He won't be able to interrupt, and it'll be a lot more scripted. And that kind of a format, frankly, goes to Biden's advantage.
All right, Bloomberg's Gregory Corti, our senior national politics correspondent. Gregory, thank you so much for your analysis there. A special programming note tomorrow. Do not miss our Bloomberg Balance of Power special, Election 2020 Swing States. David Weston will be taking a look at the voting history and demographics of Arizona, North Carolina, and Ohio, the 3 states that could very well decide the presidential election. That is Friday at 9:30 New York time and through the weekend. All right, coming up, Facebook making some political changes as the election nears, but is it too little too late? We're going to talk about that next. This is Bloomberg. With just 26 days left before the U.S. presidential election, Facebook is announcing more changes to crack down on potential misinformation. The social network now plans to ban political ads indefinitely after polls close on November 3rd. Facebook is bracing for a contentious election night. that may not end with a definitive winner. To discuss this and more, we are joined by Facebook activist investor Natasha Lamb of Arjuna Capital. And Natasha, over the last several weeks, Facebook has been making numerous announcements about their voter information center, diverting folks to accurate information about voting on Facebook. They announced a while ago they would stop taking new political ads a week before the election. And now this, no political ads after polls close. Is it enough?
Yeah, I mean, I think at this point, the horse is already out of the barn. It's 30 days before the election. A lot of the damage has already been done in terms of, the mess and the manipulation that we've seen on the platform. We wrote the company a few weeks ago, along with other concerned investors, asking them to ban all political ads at least a month before the election. But that has not been what's come to pass. And even employees at Facebook asked them to ban political ads a year before the election because of the issues we saw in 2016. So, I think, I really think it's the 11th hour. The changes that they have made are necessary. And so we can be grateful that there's some change, but I don't think it's sufficient.
Does that mean that you think on election night, Facebook could still be responsible for the election going haywire?
I mean, I think that's an unavoidable conclusion that Facebook is going to be responsible in this election cycle for misinformation, for hate speech, for fake accounts and manipulation of the platform. I think that's already a foregone conclusion. I do think it's important that they are sort of trying to clean up the mess that they've created, putting these guardrails in place. Again, I think it's necessary, but not sufficient in terms of of what we would expect. I mean, we've been pressing the company since 2016 on election interference, on fake news, on content governance, on all of these things. And the question is, how much pressure does it take for them to sort of hit a threshold and act? At this 11th hour, there's been a lot of pressure and they really haven't acted. And in the way that we would hope and expect, in a proactive way. And unfortunately, these issues are really material to investors. And we saw this summer a, hashtag Stop Hate for Profit campaign where 300 major advertisers pulled out ad dollars, which is the bread and butter of the company. And now we're seeing, threats of regulation. And our hope always as investors and as activist investors is that a company acts in its own enlightened self-interest, is proactive, and deals with these issues early and often, and not with this kind of a Band-Aid approach.
We're going to get to the regulatory issues in a moment, but what about banning QAnon, the conspiracy theory movement? Facebook had taken incremental steps to get them off the platform. Now, if you actually go to some of these groups and pages, they are gone for now. Will that make a difference?
Well, I'm glad to see Facebook follow the lead of other social media companies in banning QAnon. But, again, they're doing it sort of at these last moments. And why, months ago wasn't QAnon banned? It feels like kind of this come to Jesus moment for the company. But you really have to wonder when you have a hate group that the FBI, says is a domestic terrorism group, being, finally banned after so much pressure. They're just not stepping up. I mean, we saw in Kenosha, Wisconsin, what happened with this group, the Kenosha Guard, that basically put up a call to arms on the platform to bring action against peaceful protesters. And it was flagged 455 times and was seen by Facebook, and they didn't do anything and they didn't take it down. And then, that group was responsible for the death of 2 people. So, the question is, when it's not really like what's happening now. When is the tide going to turn and the company get proactive, and not when it's already too late? I mean, that's really always been our issue with the company.
So speaking of what's next, the House Antitrust Subcommittee dropping a massive report in which they recommend some pretty dramatic remedies to curb the power of big tech, including Facebook, and new laws that could pave the way for Facebook to be broken up. They claim that Instagram would have grown even bigger without Facebook, and that Facebook considers Instagram and WhatsApp its biggest competition in social media, which might be the very definition of monopoly. How big a risk is this to Facebook?
Yeah, I mean, I think it's a big risk, and I think that members of Congress were right to point out the overconcentration of power. I think we see that with a lot of big tech companies, in particular, having Facebook called out. You can see why that would happen. That they really haven't effectively managed a platform with 2.7 billion users. And because of that, they've made themselves a target, which is unfortunate. This is why we want the company to be more proactive on these issues. I think, if you're really going to deal with overconcentration of power, Facebook should be kind of immediately looking internally about the overconcentration of power within its own structure, which I think would assuage some regulators' concerns. Because right now, between management and Zuckerberg, they really have a chokehold on the shares. They have super voting shares. And so, other investors, mainstream investors, are a minority and just don't have the voice that they do at other companies. It's similar at Google, that same kind of a structure. And, I'd like to see more women, more people of color in positions of power at the company. We've been asking them to add a human and civil rights expert to their board to get some diversity of thought and addressing some of the biggest issues that they're facing as a company. At the same time, I think there's work to do internally. There's also work to do, externally. And I think the way that they've handled Instagram and WhatsApp is regrettable. And one does need to wonder, having smaller, more nimble companies, more innovative companies, would that help solve some of the problems that social media has created? And in fact, that could be a good thing for investors, because when you start to get these behemoths, they hit up against a ceiling of growth, and there's just not the innovation and the growth that you want to see.
All right, some strong words. Natasha Lamb of Arjuna Capital, an activist investor in Facebook. Natasha, always good to have your perspective here on the show. Thank you. Coming up, dozens of employees are leaving cryptocurrency exchange Coinbase over a management mandate with which they disagree. We will find out why next. This is Bloomberg. The cryptocurrency exchange Coinbase is losing dozens of employees who are protesting a management mandate that bars political activism at work. CEO Brian Armstrong said in a blog post today that some employees had accepted an exit package offered to those who disagreed with the policy. Joining us now for more, Bloomberg's Ed Ludlow. Ed, this has created a lot of controversy in Silicon Valley. You've got CEOs who agree with this, CEOs who disagree with this, duking it out on Twitter. What do we know about the Coinbase employees who've chosen to take this exit package?
Yeah, it's about 60 employees that have taken the exit package. That's based on the 5% of the workforce figure that CEO Brian Armstrong put in his blog post. He warned that number could rise because talks are ongoing with a number of other employees. A source told Bloomberg today that actually the number of employees that had expressed interest in the exit package was actually a little bit higher than that. Anyway, look, when Brian Armstrong made the original post on September 27th explaining his rationale behind these policies, he basically said that companies throughout Silicon Valley conduct social activism, but that he thought it could damage value in those companies because it was both a distraction as well as it creating internal division, and not every employee agrees with the other's point of view. And what sources have told Bloomberg is that employees were shocked by those policies at Coinbase. They didn't also agree with the method by which he delivered them. But beyond that, they felt that these rules were going to prevent conversations that should be taking place in the workplace. Another thing that Brian Armstrong talked about was that there was employees that came forward and said that these new rules could disproportionately affect employees who were a part of a minority group or an underrepresented group in society. And Brian Armstrong added in today's blog post that that wasn't the case, that within that group of employees that had taken the exit package, that wasn't reflected, that it had disproportionately impacted minority groups.
Now, just to pull some lines from his original post, Brian Armstrong saying, "I want Coinbase to be laser focused on achieving its mission. We will do this by playing as a championship team, focused on building and being transparent about what our mission is and isn't. We won't take on activism outside our core mission at work." The indication was that employees and the company would still take on activism as it pertains to cryptocurrencies in particular. Is that correct?
That is correct. He said, yes, we are okay about being political when it comes to cryptocurrencies because it does relate to the core mission. Look, cryptocurrencies were introduced by computer hackers and libertarian computer programmers, right? The sorts of people that were trying to circumvent the overwatch of regulators and government, an alternative system to the global financial system. Last week, probably the most notable of the voices who criticized Armstrong was Jack Dorsey, right? Twitter's CEO, who is himself an advocate of Bitcoin and other cryptocurrencies. And he basically said that Armstrong's rules went against the founding principles of cryptocurrencies. On the other side of the debate, you have investors that say what Coinbase should be doing is basically sticking to the core of the function of its business, allowing cryptocurrencies to be a method and a way of connecting financial institutions and people throughout the world, just allowing people to conduct financial transactions. And the point that Armstrong made in his blog post is that that is what Coinbase is trying to do. It's not trying to go with the origins of what cryptocurrencies came from. It just wants to facilitate payments, and at its core, that aligns with the mission. Again, cryptocurrencies are inherently political, though, right? You have all this attention from Congress. Think of when Zuckerberg, Facebook's CEO, went before committees and had to defend Facebook's entry into cryptocurrencies with Libra. You have central banks like the Bank of England, the Bank of Japan, the European Central Bank coming together earlier this year saying they too would look at the role of cryptocurrencies.
Okay.
So no matter which way you look at it, you know, it is at the center of what Brian Armstrong is talking about. Yes, you can talk about politics, but only in the context as it relates to what they're trying to do as a business, and profit and their ability to succeed as a business, what he wants them to focus on.
I'm sure, Ed, that this is not the last we will hear about this. Pretty dramatic developments over at Coinbase. We'll be watching to see how this plays out, if any more employees do decide to leave. Bloomberg's Ed Ludlow, thank you so much for that update. All right, coming up, the rise of SPACs, a newly popular route for tech startups to go public. We're going to hear from longtime venture capitalist Keith Rabois, who recently chose to take his own company public via SPAC. He's also a partner at Founders Fund, which has backed some of tech's biggest names, including Facebook, Airbnb, SpaceX, and Palantir. Keith joins us next. This is Bloomberg. Welcome back to Bloomberg Technology. I'm Emily Chang in San Francisco. A new favorite financial structure, SPAC, or Special Purpose Acquisition Company, is having a moment among tech firms wanting to go public. With looming volatility that has come with a raging pandemic and a critical presidential election just weeks away, SPACs are billed as a shorter, more predictable route for startups to make their trading debut. Home sale website Opendoor was among the latest to opt for this route instead of a traditional IPO. Joining us now for more, Keith Rabois, co-founder of Opendoor and a general partner at Founders Fund, which has backed companies like Airbnb, Palantir, and Facebook. Keith, always good to have you here on the show. So Opendoor is a fairly young company by Silicon Valley standards. Why did you decide to go the SPAC route, and why so fast?
Well, there is a premium on speed right now. I think there's a lot of perception that post-election, the volatility in the United States may increase in the markets. Who knows what the driver is, whether it's healthcare, election stability, predictability, policy changes. So many companies that are ready to be public companies are focused on time to market. There's advantages to being a public company. As you know, I'm a big fan of being a public company early in a company's trajectory. I've written a chapter in a book called High Growth Handbook that explains all the benefits. And I think many CEOs are recognizing that there's significant benefits in terms of transparency, accountability, and access to capital in being a public company.
So how are you advising your companies right now in terms of whether or not to do this? What should the numbers be? What should your revenue look like? How do you know if this is the process for you?
To me, as soon as a company passes $50 million in revenue and has predictability and visibility into its future prospects with high growth upside, it should be a public company.
That said, the process is shorter. There's not as much due diligence. How do investors know whether or not they should take a risk on these companies? Do they bet on the jockey or the horse?
Well, I disagree that there's less diligence. I don't think that's actually true. I think there's just as much diligence in an S4 SPAC process as in a traditional S1. There are some subtle differences, and we can talk about those, but I don't think the quality or the standard or bar is any different.
What about the direct listing route, which of course Palantir opted for? Your longtime friend and colleague, Peter Thiel, one of the co-founders of Palantir. Some investors have been frustrated by the process and the returns thus far. Do you think Palantir made the right choice?
Well, I think basically everything from a traditional IPO to a direct listing and a SPAC are all very similar processes, and there are different tools for different companies that have different needs. Some companies need to raise a lot of capital, and a traditional IPO may be a very good choice for them. Some companies actually are profitable and don't need additional capital, and a direct listing absolutely makes more sense. Some companies have additional premiums on speed or want to guide more constructively into the future, 1 or 2 years out, and a SPAC may make much more sense for that type of company. So I think all of these are legitimate options. And Andreessen Horowitz, which is a fund we compete with, published a very interesting blog post that explains all the choices and the pros and cons of each technique. And I think each board of directors and each CEO should evaluate them very carefully.
When it comes to Palantir, there's also been concerns about the governance and how much control Peter Thiel and the other co-founders have retained. Is that something that investors should be concerned about?
Well, without speaking to specifically about any one company, because as you know, these sort of special class rights have been applied to a vast preponderance of companies from the New York Times to Google over the years. I personally don't believe in special class voting. I've always been opposed to that. I think it should be one share, one vote. But that's a sort of train that's left the station that has nothing to do with Palantir.
Okay, let's talk about the market dynamics right now. We've got a big presidential election coming up, a lot of potential volatility ahead in the middle of this pandemic. Airbnb is a company that Founders Fund invested in a long time ago. They're looking at going public in December. Is there a risk there, given that the IPO window has remarkably been open for the last few weeks? A lot of these tech IPOs have done very well, but is December too late? Could that be a bad time?
Well, again, I can't speak to a specific company like Airbnb that we at Founders Fund or I personally may be a shareholder in. But generally speaking, I think that post-election is more treacherous for any company that wants to go public, and public companies as well may see some more choppiness and volatility in the market. I think there's a premium on going public in 2020 because if Biden is the next president, he almost surely will raise capital gains tax rates. And so the net effective return to many people in 2021 may be very different than it is in 2020. So I would expect a sell-off in public equities in the end of 2020 if the Democrats win certainly the presidency and the Senate. We're definitely in for a tax increase.
Interesting. So the debate about politics and business has been continuing here in Silicon Valley, and you don't shy away from any debates, and I know certainly not this one. We were just talking about Coinbase CEO Brian Armstrong basically banning political activism at work unless it pertains to cryptocurrencies. Now there are 60 employees who are leaving the company. We've seen various CEOs taking a stand on both sides of this issue. Jack Dorsey, your former colleague at Square, says that Brian Armstrong is basically going to be on the wrong side of history. What do you think?
I think he will clearly be on the right side of history. You saw the data today that came out that even with a very generous offer of 6 months, basically free money, only 5% of the workforce decided to take the free money. So the trouble at work is created by a very small minority of employees, and companies have been too sort of afraid to crack down on a very small fraction of people. But Coinbase employees voting with their feet at 5% is showing the high watermark of the employee activism. I think Facebook's been pretty stringent. I think a couple of years ago, Mark and Cheryl decided to basically say, there's limits to what you can do at Facebook. And if you don't like it, there's plenty of other jobs in the world. And I think more companies need to do that. It's not surprising to me that the more the monopoly a company has, the greater the employee dissonance is. So, Google, where they've been running a monopoly for many years, employees have a lot of free time to stir up activism at work. Many companies actually have to, per Brian's email, focus on their mission, or they just won't be successful companies. So, I think that this is a luxury of the top 1% of companies in many, many ways. Most companies do not have the time and energy to do anything except improve their contribution margins, improve their growth, improve their CAC. There's just so many fundamentally challenging things in building a real company, but the monopolists have plenty of time to give their employees 20% off or allow them to create, sort of internal wars over various policy issues.
Okay, so you used the word monopoly several times there. The House is recommending a dramatic overhaul to competition law that could lead to the breakup of Facebook, Google, Apple, Amazon. Are those four companies monopolies? Should they be broken up?
No, Google may have some monopoly products and some monopoly issues. The others absolutely do not. I mean, Apple doesn't even have a majority market share in any product that they sell. So it's just silly. The House report is intellectually bankrupt. It's one of the dumbest pieces of paper I've ever read from the government. For example, empirically, it argues that VCs are afraid of investing in technology and innovation because of the powers of those four companies. That's just factually false. Since 2013, venture capital has been on an explosive tear. There's more and more venture capitalists. There's more and more dollars. There's more and more companies that get funded every year. It's the hottest. I've been spent 20 years in Silicon Valley. This is the hottest venture market in my entire career, literally this month. So it's just absolutely fiction. It's really intellectually fake news put out by the government, and it really is embarrassing.
Fake news put out by the government, Keith. That's a dramatic statement, even coming from you.
It's actually.
Why do you think it's fake news?
Because the people there are just either completely ignorant or intentionally ignorant about business. So at the end of the day, Scott Cooper yesterday from Andreessen Horowitz published the stats. Anybody with a fundamental, spent 5 minutes researching it, would know that venture capitalism is increasing. Innovation in startups is increasing, not decreasing. And there's no empirical data that supports the argument put out by the House report. There's not a single shred of evidence anywhere in society that supports that argument. It's completely manufactured and fabricated.
So you alluded to this, but what is your prediction for the investing climate in Silicon Valley in 2021, coming out of a pandemic, hopefully, out of a presidential election, potentially still being in an economic recession? We don't know. What is the state of investing and opportunity in Silicon Valley in that environment?
Well, nobody knows, truthfully. And, one would have guessed post-March that, we'd be investing more cautiously at lower valuations, just given the turbulence in the world, given the issues that the world's confronting. But public market valuations have been off the charts. And over the summer, private market valuations started catching up with the public comparables. And so right now, it could not be a better time for any entrepreneur to raise money at any stage. I suspect some of that does change. There's a delinking between late stage rounds and early stage investing. So when we invest in seed or Series A companies very early in a company's trajectory, we actually really don't care what the public markets are doing because we're investing 5 to 15 years ahead of when those companies are growing up. So it would be irrational to try to project what the world's like in 2030 right now. But that's what we're really doing when we fund a seed and Series A company, is building a company for 2030.
Okay.
The later stage rounds, the companies that more and more people are familiar with because more and more consumers use their product almost by definition, absolutely there's a relationship between how they're valued and their access to capital and how the public markets perform. But those are more tightly linked and somewhat more in jeopardy post-election.
All right. Keith Rabois, we can always rely on you to keep us interested and entertained. Thank you so much, Keith Rabois of Founders Fund there. Coming up, we will have more of Bloomberg Tech after this quick break. We will take you into a socially distanced operating room. Operating rooms bustling with surgeons, aides, and students are not an ideal environment for social distancing, but Avail Med Systems is promising a better way to manage this crowding in the age of COVID using mobile overhead cameras to project live images of a procedure up to 30 times their actual size. Joining me now, Avail co-founder and CEO Daniel Hawkins. So, Daniel, tell us a little bit more about how the technology actually works.
So, procedural telemedicine, which is the technology that Avail has created, is really to address the fundamental need that surgeries in all types, ranging from 25% of the time to even 100% of the time for pacemakers, need outside expertise in the operating room to be able to conduct those surgeries. The way the technology works is we have a dedicated piece of purpose-built hardware that has cameras and image processing equipment in it. And then there's plugins for all those things that doctors need to be able to conduct a surgery. If you think about minimally invasive surgery uses cameras, we have plugins for the cameras. We have plugins for X-ray machines and the like into the back. And remotely, what somebody's able to do is participate in a procedure by accessing all of those video images in real time. Everything they see remotely and choose to watch is then displayed directly on the screen inside the operating room.
So hospitals are notoriously underfunded. What exactly is the cost of the hardware and how do you make money on this? Tell us about the math.
So we actually place our dedicated hardware into operating rooms without charging for the hardware. We are essentially a time-based SaaS model. We charge for access to that hardware in a network of operating rooms across the country.
So who's buying? Give us some names of the folks who are interested in this technology.
So we have contracts with over a dozen medical device companies, and by those I mean the largest companies in the world that make knees and pacemakers and hip implants and that sort of thing. I'm bound by contract where I can't actually say the names of most of them, but one of the ones that has given us permission is Smith & Nephew. They make knee implants, hip implants, and other orthopedic medical devices.
Now, if I'm a patient and I'm going through a surgery, don't I want the medical expert by my side? Am I losing anything by using this technology?
What you actually want as a patient is the expertise in the room. And as it turns out, they can't always be there. Logistics makes that difficult. If you have two places to be at once, you can't do that. With our technology, one of those experts can be in a procedure, finish it, go down the hall into another room, and be available for a procedure in another location. We actually increase access to expertise that way.
Has the pandemic then boosted your bottom line? Has there been an increased demand because of the circumstances we are facing?
Most certainly. So initially with the pandemic, the interest in our technology went up dramatically, but that was more about access than it was anything else. What quickly became obvious to the medical device companies is actually this is a better way of doing business. Fundamentally, for the last 40 years, expertise can only be delivered in person. We allow expertise to be delivered from anywhere to anywhere. That leads to the better expertise during a procedure, better outcomes, and ultimately a lower cost for care delivery using what we call procedural telemedicine, which is a mobile version of support like I've described.
All right, fascinating technology. We'll be watching to see how the company progresses. Daniel Hawkins, Avail Med Systems co-founder and CEO. Still ahead, IBM's big strategic move today from its CEO, Arvind Krishna. We're going to have all the details ahead. This is Bloomberg. IBM announced a big structural change today, saying it would separate its hybrid cloud and AI business from its services component. Earlier today, CEO Arvind Krishna gave Bloomberg's David Weston all the details.
Pre this announcement, we were a majority services company. Post this announcement, IBM will become over half as a software and solutions company, and even a larger number in terms of overall product. And if I look at the annuity base of the new company, it's about a little over 50%. So if I look at that, that's a very attractive company that promises a different valuation than the current structure. So that is a piece of it, but I think it's actually more the growth and the addressable market opportunity of $1 trillion that I think is driving it. But David, you're closer to that audience than probably I am in terms of how they think and how they react.
So Arvind, what will be the relationship between these two companies? Will they be contracting with one another? Will they be free to contract with other people that might be even a competitor of their sister company?
Both. So absolutely. You unlock growth for both companies by being allowed to partner with those that may be competitors. Certainly for Nuco, they may today not so much be restricted, but others who are competitors of the aggregate may feel reluctant to partner deeply with them. That gets unlocked. No constraints, no restrictions on that side. Now that said, I think it's likely that we're each other's biggest customers on day one post-spin. They certainly purchase a lot of hardware and software from IBM. IBM certainly purchased the services from Nuco in terms of how we run IT infrastructure and so on. So the two companies are going to have a deep strategic relationship, but that is not going to constrain them both from partnering with whoever they want to.
Arvind, what can you tell us about the leadership of the two companies going forward? Who do you expect to be the leaders of the two? I assume you're one of them. And what about Jim Whitehurst from Red Hat? What role will he have going forward?
So both Jim and myself remain with IBM. And a lot of the leadership who runs the businesses at IBM is going to stay at IBM. The leadership who runs managed infrastructure services goes with Nuco. Now, as you know, in these spins, the board, the governance structure of IBM stays in place because the company is staying in place. In the Nuco, we have to create a new board. Once that new board is formed, they'll be able to select its top management team. We certainly expect that they will select many people from the current management team. But as that goes forward, the new board of the company will select the overall leadership. But in terms of the day-to-day operations, a lot of the people are in place. They run infrastructure services today, and they will continue to do that.
Arvind, you clearly want to gain some growth by freeing up the hybrid services and the AI part of the company. Do you also run the risk of losing some, of essentially cross-selling, have customers you can cross-sell both sides of your business?
I think that that's a risk that can be managed, David. So the word I would use is, I don't have any concerns about it, and then I'll sort of say, of course I'm going to be paranoid about it, and I'm going to have lots of work around it, and so I'm going to mitigate any of that risk in terms of how we work. There are certainly common clients across both sides of the business, but the clients tend to contract separately for the different parts of the business already. So we have to go manage that risk. But as I said also, the two businesses will have deep and strategic relationships with each other, and that will also help mitigate that part of the risk. So I think we'll unlock growth, and I think that the risk on the aspect you mentioned can be mitigated.
This is obviously a very big initiative of IBM. It'll take a while, I'm sure, to put it all together to digest it. When do you expect the spinoff to be effectuated?
We believe, based on history and looking at others who have done similar spinoffs, they seem to take about a year to get done. So I'll say a year plus minus a few months. So that takes us into the latter part of 2021. We have to get through all of the structure of the new company. We have to file to the SEC, the S-10s. We expect that'll happen somewhere early to mid part of next year. You get to get through all of those approvals. You got to get to a final board approval, and that then allows us to impact all this. But I think 12 months plus minus some number of months is probably a good timeline to expect.
Arvind, you and I will say, both understand that when you have this major structural change, it consumes a lot of executive bandwidth. As a practical matter, that probably means you're not going to be looking at other acquisitions or dispositions over that 12-month period. Can you look out beyond that? Do you see further structural changes coming up for IBM to pursue that relentless desire for growth that you describe?
I absolutely expect to be completely focused on acquisitions as well as on organic R&D and organic ecosystem investments. I don't believe we will pause them in this period. You then talked about other structural actions, meaning divestments. We are not planning anything else that is significant. So this will take time. You're right. It is major, and it will take a whole set of people to go get this done. And but in the meantime, we are focused on growing both those companies. So they will take the appropriate actions, whether it's organic and inorganic investments, meaning acquisitions, to go get themselves positioned. We fully expect to be down all those paths at full speed.
IBM CEO Arvind Krishna there with my colleague David Weston. GameStop shares jumped today after a strategic partnership with Microsoft, giving investors optimism that the video game retailer can turn around its business. Under a multi-year agreement, GameStop will use Microsoft's cloud services to handle business operations, including finance, inventory, and e-commerce. The retailer will also offer Xbox All Access, a monthly service for the Xbox console. And that does it for this edition of Bloomberg Technology. Bloomberg Daybreak Australia is next. I'm Emily Chang in San Francisco. This is Bloomberg.